Let me ask you a question. So I have this real life case scenario that I've talked about before where someone sent me their budget with about $5,400 of income, $5,400 of expenses, and $4.10 left over. And this person had 22 debts, right? 22 debts. So do you think the bank will want to teach you how to get out of this? Be a responsible person? Or do you think the bank wants you to feel like you're drowning, but not actually drown? See, the thing that the bank hates the most is someone who pays their bills 90 days late, right? So if you have loans, credit cards, and you're more than 90 days late, that's the magic number, the bank definitely hates you. And you know what else the bank also hates? People who pay their bills too early, okay? So if you have a 30-year mortgage and you paid off a mortgage like less than 3 years like I did in real life, and I have to add the words "in real life" because people won't believe me when I say that, um, do you think the bank would like that either? No, they won't. What they want is a person who makes money, but simply doesn't really know how to manage it, right? Someone who has that income, but the bank can drain their income out of them with many, many debts and minimum payments, but not up to the point where this checking and savings that's left over becomes negative, right? So I'm going to tell you the secret that the bank will never teach you nor its employees. Okay. And by the way, we actually went through this scenario in a paid members only live stream for 99 cents. And at the end of the live stream, we paid off all the 22 debts and had an estimated projection of 10 years of the complete debt completely paid off and about 300K of it, right? So the whole total debt was 300K and took us about 10 years. And I'm going to show you how we do this using something called the velocity method. Okay. So look at this scenario. Okay. So someone makes good income and has the same amount in expenses with $0 left over checking and savings. Now, what do you think the bank's agenda is? Do you think the bank wants a person just to make minimum payments over time and that's it? Or do you think the bank is in the business of telling you how to pay off your debts quickly? And you have to think from the bank's perspective. Don't think um, in from your perspective what you want. And this is why people get surprised when they pay off debts early when their credit score dips a little, right? Because what when your credit score dips because you pay off debts too early, that simply means that you're kind of a bigger risk to the bank than someone who just pays on time and doesn't need money, right? So we're gonna go over that a little bit later. But this is a good question to always ask your friends. And I always love showing people this is like, hey, you make this amount of income, you have this amount of expenses, and you have $0 checking and savings left over. Do you need to make more money to get out of this hole? Right? That's the question I always ask. And 99.9999% of people, especially if I've met them for the first time in real life and then I'm doing a pitch to them, will say yes. And what we're going to show is, hey, even with the same income and the same expenses, uh, we don't need to do that. Okay. So this is what we're going to do. We're going to show with the same income and the same expenses how we can turn $0 into, I think, what, more than 4,000 or $5,000. I don't remember the number, right? But we'll turn it into more cash flow without making more money. And a lot of people get shocked by this. Okay. Now I'm going to tell you the difference between the left side and the right side. So left side and the right side look exactly the same, but the difference is that on the left side, your checking and savings account is like the final destination of your money, right? So how does this work? Well, basically, it's average American banking, right? You get paid, you pay your bills, and then you put the leftover in checking and savings, right? Final destination of your money, even though we have nothing here. Whereas with the velocity method, okay, we get paid into our checking account, and then all of our money goes into a line of credit. It goes into debt, right? So the checking account is not the final destination of our money. It is our line of credit. All right. And This makes an incredible difference if you have a line of credit. If you've never heard of a line of credit, it's basically a financial tool where you can borrow money, pay it back, and then use it over and over again, right? Line of credit. A credit card is technically a line of credit, but it's different from a personal and home equity line of credit, right? So what's different from what makes a personal home equity line of credit different is that if I can go to a bank's website, click a button, I can dump cash into my checking account, and it doesn't matter how much it is. It could be $5, $10, $100, up to the limit. Okay, up to the limit. And basically that's what we're gonna do, right? So we're gonna do it up to the limit, and that's really cool because most people don't know you can get instantaneous cash from a financial tool from the bank without doing anything. Because when they see credit cards, and the only thing that is closely available to that with credit cards is cash advances. Those are expenses, and those have fees. I remember I did a cash advance once. I tested it, and I think I borrowed like $100 for my credit card. And then I borrowed $100. It was like a 20 to 30% interest charge. And not only that, the bank charged an additional $40. So it's crazy how, cash is not really accessible with the credit card, but with the line of credit, that's basically what the tool is for. Okay. All right. So we have $200,000, 8% line of credit, right? $200,000, 8% line of credit. And what we're going to do is we're going to move some of our debt into that line of credit to increase our cash flow. Okay. Now, can you dump all of your money into a credit card? Kind of, but it's really hard to do this with a credit card, right? People ask, how do I do this with a credit card? That's kind of like saying, how do I play basketball with the baseball? I don't know. Like to me, and the reason for that is because it's simply a lack of familiarity, and there's not really any marketing for lines of credit, right? Because if you go to a basketball game or you watch like sports on TV, they always tell you stuff like brought to you by Visa, right? But they don't tell you brought to you by, local credit union's line of credit. In fact, I don't even think I've ever seen a home equity line of credit commercial ever in my life, right? I had to go Google it and be a little bit proactive. Okay. So that's what we're gonna do. We're gonna just move some debt into a line of credit and increase our cash flow. And we use the cash flow index to help us figure this out. So basically, you have this debt amount divided by the monthly payment, and then you have the cash flow index. And then what this is a ranking system, and the lower the number, especially below 50, you want to pay those off. And then the higher the number, that's the one you want to pay off last, right? Because think about this. Mortgage payment's $250,000, or the mortgage amount's $250,000. How much cash flow do you get? You get $1,100, right? $1,193. Whereas I could just simply pay off this 35 grand credit card and I get $1,137 in cash flow. So it's almost the same amount. So why would I pay $250,000 for only $1,100 in cash flow when I could pay the 35 grand for that same amount, right? So think of this in terms of bang for your buck, the cash flow index. And so how much was this? This is 5, 8, 15, 27, 30, 7, 10, 35, 12, 15. And by the way, I don't know who the inventor of cash flow index is. I thought it was Garrett Gunderson, and he may have just popularized it. I can't even speak English. Popularized it, but I actually found another YouTuber. I think his name is Chris Miles, and he said he invented it. So let me just take a look. Chris Miles cash flow index. All right, let me just take a look. So basically, this dude said he invented the cash flow index. So I'm wondering, is this true? And here's the other thing too. Like, he may have invented it, but I've heard this guy talk bad about what we're teaching. Okay. He's like, don't do it. It's dangerous or something like that. Okay. But if he invented it, kudos to him. I thought it was Garrett Gunderson, but whatever. Okay. All right. So now let's go back here. And then what we're going to do is move some of our debts into the line of credit. So I'm going to go ahead and sum it up. And that's $164,000, right? And guess what happens by simply moving that debt into a line of credit? These payments go to zero. It's just basically balance transfer, right? And then we literally went from 0 to $5,160.71 without making more money. What? Yeah, look at that. The income is the same. And all we did is just shift some expenses. Now, the final step of this is we put our entire paycheck into the line of credit, take our expenses out, and then rinse and repeat over and over again, right? So paycheck in, expenses out, and after every single month, the balance will go down by $5,000. See? Now, think about this. Compare this to like Dave Ramsey's method, the baby step. Baby step one, save $1,000. That is going to be such an incredible struggle to save $1,000, right? Why save $1,000 when you could go from $0 to over 5,000 in an instant? Now I'm going to address the elephant in the room, right? A lot of times people think when they watch these presentations, because they're kind of new to the whole game, and I get it, right? Because I remember I had the same feelings when I was learning all this, is that you can't get a free and clear line of credit if you go to a bank, right? So if you have all this debt and you have $0 left over and you go to a bank, and you ask the bank, like, hey, can I get a home equity line of credit for $200,000? You know what they're going to say? They're going to laugh at you, because banks don't lend money to people who need it, right? Banks don't lend money to people who need it, because people who need money don't pay you back, right? Something I have to emphasize. So let me just kind of show you here, let's go ahead and look at this picture, right? I posted this on the community feed. Banks don't lend money to people who need it. I like how his name's Mr. Bumblewick. Denied. He looks like Peter Griffin. Peter Griffin with a smile and then the monocle. That's when I'll have made it. I should get a monocle, just get a monocle and have a denied, what do you call it, stamp, and call myself Mr. Bumblewick. But yeah, banks don't lend money to people who need it. Now, you might be asking, if banks don't lend money to people who need it, why do you teach it this way? It's because if I show you a realistic scenario, kind of like this, and let me just kind of show you this right here, where people, if they have a line of credit, they just treat it like a maxed out credit card. Oh man, we'll be here for life. We'll be here forever. I remember when I did this last year, it was 1 hour and 30 minutes. It was like, can I really do this? And it turns out, yeah, I could. And it's actually easier to understand when you have a free and clear line of credit. You'll see what I mean when I teach, go over this. And you could see like, whoa, if I had a line of credit, I could have easily gone from 0 to 5,000. Yeah, I know you could have easily gone that, but you can't. You know why? Because you're trying to get the line of credit when you need money. And so yeah, there's an order of operations where you have to do these things. Got to remember that. Okay. All right. So now let's do the final step of this, which is you put you take the initial, or I'm sorry, if you want to get the next month's balance, you take the previous month's balance plus the previous month's interest minus our cash flow. So 5160.71, and let's go ahead and calculate that interest. So I'm definitely going to do that, right? And then we're going to multiply it by 8% and then divide by 12. And then I'm going to go ahead and copy and paste. And this is going to be 36 months, right? 36 months. And I'm just going to go ahead and do this. So 36 months. And then, okay, so this is going to be, how much was that? 164K. 164K. So let's go ahead and do this. 164K. Okay. And then we have the auto loan and the mortgage, right? So now what I want to do is in 36 months, right? So 36, what I would like to do is show that we should pay off the auto loan first. So this is our loan calculator right here. Actually, was it 46,000 auto? Yeah, we have our loan calculator. So this is our loan calculator. 46,000 original balance, 3% interest rate, 5-year term. Now, if you put the current month here, this is your current balance, and then you notice with the cash flow index that we're gonna pay off this debt because we only have to pay 19 grand to get $826 cash flow back, rather than 236 grand for $1,193.54. Now, I'll tell you why I've put this in red font is because the average person would be confused and they would just be looking at this and be like, "Oh my goodness, the 4% is greater than the 3 avalanche method." And then, they'd struggle with debt. I've seen that happen too many times. I mean, Dave Ramsey says that all the time, right? Why did snowball? But this is kind of technically a snowball because it's the smallest balance, but at the same time, we're not doing it specifically for the smallest balance. It's balance to payment ratio, right? 19 grand for 826 rather than 236 for only a measly 1193. And then we could apply that extra cash flow to a 236, right? So this is what we're gonna do. We're gonna now move this 19 grand, whoopsie, into here. And then I'm just gonna go ahead and do this. And then watch this, plus 19230.72. And then this is going to be 0. And you get an extra $826 in your cash flow. Look at that. We're almost at $6,000. And then I'm going to go ahead and copy and paste. And then this is going to be right here. So 5987.27. And then we're going to copy and paste. And then now in 39 months, we've completely paid off that debt. Okay, so now let's kind of do this right here. So 39 months. It's gonna be 164 plus 46, and so it's $210,000. Bam, 0 mortgage. So 39 months. Okay, 39. So now we have $250,000. I'm sorry, 250,000 original balance and 235,000 current balance. Now, I know what you might be thinking. Listen, if I made that great of an income, there's no way I'd buy a $250,000 house, right? And it depends on where you live, because if you live in San Francisco, Los Angeles, $250,000 houses don't even exist in those areas, right? Like, you won the lottery if you have a $250,000 house, right? But in other areas of the country, they exist. Like, Michael Jackson's hometown, Gary, Indiana, the houses there are like 60,000, but nobody wants to live in Gary, Indiana, except for the people in Gary, Indiana right now, right? So, one of the things that you learn about houses is that the interior of the house has nothing to do with its value. You know what I mean? Like, if you bought like any house in Southern California, it doesn't matter what it is. Like, it could honestly be a crap hole. That house is probably like worth $1 million now. You know what I mean? But like, you buy the most pristine house, huge mansion, like the middle of nowhere, Nebraska. That house is probably only worth like, I don't know, 650,000 at most. Anyways, okay, I've rambled on and on, but real estate is very location dependent. And the way that you kind of have to think about it is that the location holds the value, because the whenever you talk to a real estate agent, they'll tell you that the value of the property is just based on what the property across the street that's similar to yours sold for, right? That's the only thing that gives the, how you estimate the value of your home, right? It's not about what the interior is, all that interior and granite countertops, you know what that's for? To get the whole home sold really quickly. That's literally what it's for, right? That's really the only difference between, you know, um, the actual value of the home and how nice it is. Okay, I rambled on and on and on, but my point is this, right? I once had someone who had really good income and had a really cheap mortgage, and he was still broke. I'm not gonna lie. Lived in a cheap cost of living area in the Midwest and still broke, with even with the like a $8,000 a month salary. It was crazy. I think I did a live stream on that too. All right, so now final thing, right? Final thing we got to pay off is that 30-year mortgage, 235,000. So we have two options here, and I'm just gonna kind of go over the difference between the two options. So the first option is extra payments, right? And the reason why extra payments is not considered by most people is the same reason why most people don't overpay credit cards, right? Like, why don't most people overpay credit cards is because credit cards have a little element of inflexibility in them. And that's especially true for loans, right? If I dump my entire paycheck into a loan, I definitely can't get that money back, because a loan is a one-way street. Now, a credit card is technically a two-way street, but you can't use a credit card to pay other credit cards and a credit card to pay other loans, or it's hard, right? You gotta use plastique.com. And with so one of the reasons why I say, hey, this method, even though it's the default option, leads to decision fatigue is because it's very hard to know, right? It's very hard to know how much you should overpay in the loan, which is why most people struggle with it. And so what we do is we're just gonna make it really easy and use a line of credit. And what we do is we call it the sweeping method, right? What we do is take small little bite-sized sweeps from the loan into the line of credit. And this is what all you have to think about is that your checking goes to zero and your line of credit goes to zero, and that's about it. And so you want to see how this looks like in real life. I'll just show you where, let's say we take $10,000 of the principal of the loan, right? And then just move it into the line of credit. So I'm just going to do this plus 10000. And look, that principal gets paid off in 2 months. Oh my goodness, look how easy that is, right? And then, so some of you might be freaking out about, oh my goodness, you have a 4% loan and you're moving it into an 8% line of credit. Are you insane? Well, there's a huge difference between moving a piece of a loan and the whole loan, right? Two completely different things. And so this is why, like, even if you use a 15% line of credit, it's not that big of a deal. In fact, I'm going to show you this. This is like a calculator that will determine the loan payoff if you use the sweeping method. So we just do $10,000 sweeps into the loan, or loan from the line of credit, and look, gets paid off 3 years, 15 grand of interest, right? Now, let's say I'm really stupid and I'm like, why would I use the 8% line of credit when I could go ahead with the 15, right? So you see this 15 grand right here, and if I double the interest rate, whoa, it went up like 1 grand, right? Like, when I first saw that, I was kind of blown away. I was like, whoa, I thought it would like double or triple or something like that. We're going from 8 to 15. But even if we go to 30, ooh, right? So, you might be getting some ideas here. Well, let's say you do have 30% credit cards and then you use it to pay the mortgage with Plastique. Now, if you do this right, you probably don't have to pay any interest because, the credit cards have a 1 month float period. But you do have to pay probably like that 2.99% fee for paying your mortgage with the credit card, right? So there are some, some, what do you call it? Disadvantages, but it's, even, I want to say disadvantages, but there are some trade-offs, right? So you could even use a 30% credit card and just keep swiping, get these rewards points, and who knows, maybe like in a year's worth of, or 3 years of paying off the mortgage with the credit card, all you have to do is pay that 2.99% fee. And actually, let me just kind of really calculate that. So it would just be 250,000 times 0.0299. So it will only be, let's say, 7 grand worth of fees, right? If you know how to do this right, you don't have to pay interest, because the interest, if you pay it off in full in like 1 month, you have it's like a credit card's like a 1 month free loan if you always pay off the statement balance. And then if you have like greater rewards than 7 grand for those 3 years, then the credit card is essentially paid for itself. That's one way you could kind of think about it, even if you want to use a 30% credit card, right? Now, a 30% line of credit is technically different from a 30% credit card because a line of credit doesn't have that feature where essentially you can use that credit, or I'm sorry, it doesn't have that feature where you can delay a month's worth of interest, or just like not, with a credit card, you pay the statement balance every month, pay no interest. That's not possible with the line of credit. So this is assuming this is a regular line of credit. But anyways, let's switch this back to an A. What happens if I do a 0% or 1% line of credit? That doesn't even make a difference too. Well, if I had a 1% line of credit, oh my goodness, this is crazy. Like, people think like, oh my goodness, 4 to 8. Now, I will tell you what makes a difference. You want to know what makes a difference? Moving the whole loan into a line of credit. That's a death sentence for most people, right? Look at this, 15 grand, 31 grand, right? Now, because we have so much cash flow, we can still offset that. But when you deal with, figures that have tight margins, that's what I would say. then you'll struggle a lot more, right? You'll struggle a lot more. All right, so now let's go ahead and do this. So, $10,000 line of credit or sweep amount paid off in 3 years. So let me ask you this, you think the bank will teach you this? F no. They don't even teach their own employees how the banking system works, right? You go to the bank and actually I've had this happen to me. Like, okay, I've probably applied for maybe like a line of credit 6 times, right? If you include home equity and personal, 6 or 7. And there's only been one time this happened to me, but I specifically went to the bank's website or the credit union's website, applied for a line of credit, and they tried to give me a loan. I thought that was a myth, but that happened to me one time. Okay, so you got to be careful, right? So maybe the first 5 times, the bank, respects your request for a line of credit, and then the next time, the final time, they try to sneak in a loan. I was like, wait a minute, I didn't apply for a loan. It's like, but it's like, and I remember clicking on the the website. I wanted a line of credit, and those sneaky people, sneaky people, try to give me a loan. I want to use the B word, but we're a rated G channel, I think. All right, so now it's 39 12 plus 3, so that's 6.25 years, and we are debt free. Debt free. Oh, debto frio. I think that's how you say it in Spanish, right? No, I just totally made that up. But anyways, all right. So now we're at the 26-minute mark. But yeah, bank will never teach you this. The bank will never teach you this. You think the bank wants to teach you this? No, they will never teach you this. All right. So if you made it to the end of the video, just type in the comment box below that the bank will never teach you this. Okay. That's how you let me know that you watched the end of the video. So have a great day, and I'll see you next time.